Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, everybody, and welcome to the Stock Spinoff Investing Podcast. Today, I'm going to be talking to Christian Ryther of Curreen Capital, and this is the first podcast episode of 2025, so very excited to kick it off with Christian. And Christian, I followed you for a long time on Twitter. I get your quarterly letters, and one reason why I wanted to have you on the podcast is I think you pretty much follow every spinoff that happens, and you've had a lot of nice successes in the spinoff space. One name that I can think of, Jackson Financial. I know you invested in that one, and there are a bunch of other ones that we've talked about over the time. We met for the first time actually in person at Berkshire last year, the annual meeting, and I'm going to be going. It looks like you're going to be going as well. So look forward to meeting up again. But maybe we could just talk about your background a little bit. So in just prepping for this, I knew a little bit about your background, but I forgot or learned that you were at the Columbia Business School, and you were in the value investing program. So that is super cool. I'm super jealous. And so I'd love to hear your experience with that and whether or not you had a class with Joel Greenblatt.
Oh, I did not have a class with Joel Greenblatt. He was not teaching my year. I think the excuse was that he was working on a book or something like that. But yeah, love that guy. Love his book, all that stuff. I did go to Columbia Business School. I went there intentionally to try to get into the investment management industry. Before business school, I'd done Peace Corps. I had done economic consulting. And I had worked at ISS, the proxy voting company, and sort of worked my way up. And while I was doing that, I did the CFA program and that's how I think I learned accounting. But I intentionally went to Columbia Business School because I'm like, since high school, when I read Peter Lynch, I'd wanted to do investing, and I was like, how do I get in there? And I was like, okay, I gotta go to business school, and I targeted Columbia. My girlfriend was going there for law school, which I think helped me get in. But yeah, I wanted to go there for the value investing program. And I do think it was awesome. It was a great time to be learning about value investing because it was super hot and sexy at the time, which I didn't know in retrospect. I just thought it was a better way of investing. I came out in 2008, which may have been the tail end of value investing doing better than other types of investing. It's weird. I've been reading someone put the Outstanding Investor Digest an excerpt of them or a subset of them online, and I've been reading through them, and it's just so weird because it puts me back in this headspace of that time of like when value investing was sort of winning, and how people were talking, and it's like, oh yeah, reversion to mean and like valuing things and this, that, and the other way. Yeah, it was a wonderful experience. I learned a lot, but again, it was the tail end of value investing winning. Yep.
It's so funny because I publish a weekly newsletter, and sometimes I do like a little intro with some market stats or some market commentary. And basically, I've been saying for feels like 5 years now, value investing is due and small caps are due, right? Because everybody knows it's been the large and mega caps and the biggest seven companies. The historic concentration is insane in the S&P 500. We know that this is mean reverting, but one thing that's a little scary about looking at the charts is how long it lasts,
Yeah.
right? Like I
Yeah.
think the value run was from like 2000 maybe after the market topped, and it lasted into like 2008 or 2009.
Mm.
And so it's like a 9 or 10 year run. And so you're thinking, oh yeah, small caps are due, because it's been 8 years or so of underperformance. But then you're like, could it go on for another 2 or 3 years?
Yeah.
Probably. That's like the scary part about it.
Well, I look at it as like they had that run from 2000 to whatever. But before that, growth and momentum were kicking their butt. And after that, growth and momentum were kicking their butt. So it's like it might win over time, or it might just be the same over time, but it's just got like these little periods of success followed by long periods of sadness or whatever. But like, I don't know. I see cheap stocks. I want to buy them. I'm happy to buy them. I try to be happy with that.
Yeah, exactly. Exactly. It's like just focus. I think we both just focused on bottom up, attractive situations, good valuations, good improving fundamentals, insider buying, and hopefully if you follow that process, over time it'll work out well. So you started your career in the Peace Corps in Morocco. So how was that and how did you get into that?
I worked for 2 years after college before I did Peace Corps, so it wasn't straight out. Um, it was pretty good, but I was in Morocco when the Second Iraq War started, and so they pulled us all out. So it was like an abbreviated version of the thing. And when you go into Peace Corps, at least our trainers taught us, like there's this like cycle of your emotions. You're happy for a few months, you're sad for a few months, you're happy for, like as you're learning and getting into the culture and like then not liking parts of it and more liking. And I think I was in one of the parts where it's like not so happy with Moroccan culture when they pulled us out. So I didn't get the chance to like pull up and feel better about it. I'm glad I did it. I thought it was a cool experience, but yeah, it was abbreviated.
Did they pull you out and put you someplace else in another area, or did they just bring you home?
They pulled us out and they gave us the option. I think it was like could go to Jamaica or something like that. And I was like, rar.
You're
I'm
like,
gonna
I'm
get a
done.
job again. Yeah.
I studied abroad in Spain, in Cordoba, Spain, and
Yeah.
went across the Strait of Gibraltar to Morocco for like 3 days. And I just remember it was beautiful, but I just remember everybody there, you would just get swarmed and people were like, hashish, hashish, do you want hashish?
Oh, thank
And
you.
so that was kind of funny, but yeah, beautiful country. The other thing I learned about you, not, and again, I don't know if I knew this or I just forgot, but I didn't realize that you are or were a long distance runner and that you completed a 100-mile race and came in second. Is that
Yeah.
is that true?
Yeah, I don't run anymore. Now I'm like a Peloton guy, but yes, I lived in Colorado for a year, and that was part of the period of time when I was doing ultra marathons. And so I was living in Denver, training in the mountains. I got all the red blood cells that you can. And then I competed in the Black Hills Ultra Marathon, the 100 mile. It was my third ultra marathon. I did Vermont first and had to drop out because I was like injuring myself. Then I did Chimera out in Southern California. But then I was like altitude trained and heat trained. And we had like this super hot day in the Black Hills. And I think 40% of the people dropped out. And then like they told me like right near the end, like, yeah, there's only one guy in front of you. I was like, what are you talking about? And I got this big bison skull as a trophy. I didn't even look up the trophies because there was no chance I would get like place or anything like that. I just wanted to do it. So that was, yeah, it was a pretty cool
That is insane.
benefit.
So, how do you when you're doing a 100-mile, like I assume you have to take breaks to eat, or do you eat like the goop while you're running? Like how many calories do you have to consume when you're running that race to like not pass out?
I didn't count them, but you walk a lot, especially up the hills, like
Yep.
because you can run up about 3 hills and then like that
And
doesn't
then you're
work for the
done.
rest of the time. Um, but you're eating a lot. I had like a pack with caffeinated sugar water basically that I was drinking a lot, which I think messed up my esophagus, but whatever. And then like just eating like Cliff Bars and stuff like that all the way along. And one thing I do remember is like in the middle of the night you have your like food packets like stored along the way that they ship out to various aid stations. And I had like a toothbrush in one, and that's like after 12 hours of running, like you don't produce any saliva, like your teeth start getting gross and like you got to brush your teeth. That was like the most pleasant aid station thing. But then the rest of the time, you're just drinking sugar water and eating like sugar bars.
That's crazy. I would not think that you would take the time to brush your teeth, but that makes complete sense.
I didn't the first race, and it was like, okay,
Yep.
I got to do that. That's it
Lesson
feels
learned.
terrible.
Cool. All right. Well, let's pivot to investing and spinoffs. So I know, like we've talked about, you are an active, you look at most spinoffs that take place. Um, maybe just talk about your approach to spinoffs. Maybe talk about if you want to a successful case study. Maybe talk about any lessons learned that you've learned over the years investing in spinoffs, but would love to just talk or just hear about kind of your approach to spinoffs and how you invest in them.
Yeah, I do try to look at all of them. And I think over the years, it's like some of the ones that I think are going to be cheap aren't cheap, and some of the ones I think won't be cheap end up getting cheap for whatever reason. So I'm not like, I can't tell which ones are going to be the most attractive. Like I can have some guesses sometimes. But like last year, I thought that Solventum would be super popular and GE Vernova would not be popular, and it was completely the opposite. Is how it came out. So what I take from that is like look at them, try to value them all, because like I feel like I got to put out my fishing lines, and I don't know which ones are going to get hits, which ones the fish are going to bite. So you got to just do the work and value them, even if you think they might be super popular or not. Um, I like to look at the ones that are good businesses. So I go in and I look at the business. I read enough of the description to be like, what the heck is this thing? Is this something that I can figure out? Is it something that sounds interesting or not interesting? And then I look at the financials of just like, what's the return on tangible capital? What's the return on total invested capital? Like, are they doing a lot of M&A? Does it matter for total invested capital, or is it tangible capital that matters? Because sometimes like they've got a balance sheet that isn't really reflecting how they're going to act going forward. But the return on tangible capital is like, how good is the business? And if it's not above 20% after tax, I'm not that interested. So that's like a quick filter. Like the quick filters are, is this a business that I understand and sort of like? And do they have high returns on tangible capital? And then I can like do the work and actually do the valuation. So I'm trying to look at those for all of them. I'd say one of the biggest lessons
That's
that's
like a green approach. Is it a good business? What's return
yes,
on capital and what's the valuation? Is it cheap? So that's a good way to screen them.
yeah, I didn't invent that, but that's it's working for me. And I'd say something that's coming to me lately is like if I look back over the last 15 years or whatever, when I've looked at spinoffs and been like, this is a good business. I can see why it's a good business. I can see why this continued like Veralta last year. I was like, this is a good business. And or Epiroc or like there's some of these where I'm like, this is a good business. This is a durable business that will keep going for a long period of time. But then the price comes out and it's like not cheap. And what I want to do in retrospect is just go back and buy some of all of them because they're just like, if you've got this good business that can go for a long period of time and you're probably going to get it a little bit cheaper than it should be with the spinoff, just own it. Just own maybe 1-2% or something like that. But I think I would have been happier because then I just keep looking back and I'm like, like, look at that beautiful business that I could have had it and whatever. And even if they don't do crazy great, it's just like I don't know. I want to have them because they're nice.
100%. Yeah, I mean that's kind of my curse too. I would say is that like I'm like yeah, business quality is good, but like I'm a totally sucker for like a really cheap, dirt cheap valuation, and so yeah, it can be challenging because you
Yeah,
miss these really high quality compounders.
yeah, because they're businesses with high returns on capital, and I like them, but they're not as durable or whatever. It's not like I can see this lasting 50 plus years or something like that. It's just like, this is a good business. I have to keep watching it. Those are the ones I end up buying because they get cheaper.
So yeah, so Solventum was an interesting name. That one. I agreed. Like I thought that was going to come out valued at like $100. It seemed like 3M was the bad business and this was the good business. And then the spinoff happened.
Yeah.
3M like skyrocketed and Solventum just sold off. With that one, it seems to me, I know there's some activists involved. Seems to me like that, I don't own it.
Mm,
But it seems to me like that business is probably going to get broken up. Like it's like there are four businesses. Every individual business is probably worth more than the current valuation if it were to get spun off or sold.
mm.
So curious, I know you, do you still own Solventum, or have you moved on from that one?
I still have it. Like at
Yeah.
this point, I got killed with taxes for 2021, and like since then, I'm like, maybe I'm just gonna hold on to this and get long-term gains on it, and not be in a rush. And plus, I had like a whole pile of cash for a long period of time, which I finally invested. So I haven't needed to sell stuff to buy stuff, and I've
Got
been
it.
like leery of taxes. So no, I've still got it. It's like I look at that and like this is a good collection of businesses. Health information systems, I think, in particular, is is good and is not burdened by what 3M did to this company when they spun it out, like keeping all the manufacturing and forcing them to develop their own. Um, but I think it's like a good collection of businesses. However it ends up, I'd say just let it run.
Yeah.
Um,
Yep, that makes sense. So you talked a little bit about like position size and, about, just buy 1% of a high quality business. How do you think about, managing your portfolio? So like how many names do you own? What's the average position size? Like what's the biggest you'll let something get, before kind of cutting it back for risk management purposes?
I think right now I've got 14 or 15 positions, and they're all generally smaller than I used to be. Like I used to be more concentrated, go in minimum 10% on something. If you really like it, do 20, 30%. And I think maybe I'm older or maybe I've just been burned or something like that. But I'm no longer as willing to go big on these stocks. And I know that the math is there. Like if you want to win, you go concentrated on your best ideas and you do great. But if you get punched in the face a few times, it's just like, I don't know. Maybe I want to hold back on that. Like you buy something and it goes down. It's like I wish I had that cash to buy it more. So now I'm like this transitioning state to being smaller in my individual positions, coming in smaller when I do them. And that's not. I know that's not the ideal, and I'm still transitioning out of that big, super concentrated type stuff. Um, so I don't know how big I'd let stuff go. I want to let things run if they're working. Um, but the ideal is also to find something new that I'm so excited about that I'm going to sell all that other stuff and put money into it. I just haven't seen anything the last year or two where I'm like, pedal to the metal, I want to hit this. It's been like, this is decent, I'll put some in. This is cheaper, I'll put some more in. Oh, good results, I'll put some more in. Just like nibbling away at things like that lately. So that's my long-winded answer. I don't have like a exact policy anymore.
No, that makes sense. Honestly, owning 15 names, like, I know that's not it's super concentrated in the world of like, Charlie Munger initially or Greenblatt, initially, but 50 names is still pretty concentrated. I mean, in the whole scheme of thing versus most other institutional investors. What about market cap? So do you like how little will you go? Do you care? Are you kind of market cap agnostic in terms of you just try to buy the most attractive securities?
I should be, but I'm not an emotionless robot. So I have trouble getting excited about big stocks. Like if the market cap is above 10 billion, I'm just like less interested, even if it's really good. And that's I don't know, part of my makeup. I'll do tiny companies, but I've noticed that microcaps that don't make money blow up my money. I light money on fire. I see a tiny microcap that's inflecting to positive performance, to positive cash flow, and all this stuff, and like something goes off in my brain, like heroin or something like that, and I absolutely have to stay away from those. So I'll do microcaps, but I really want them to be like able to grow without diluting, ideally, their cash cows. Like in general, I want a cash cow. They're boring. I don't get super excited about them, but cash cow spinoffs are where I make my best money. Yeah.
Yeah, that makes a lot of sense. And it's just good. I mean, everybody's different. You figure out what makes sense for you, you figure out lessons learned, and you figure out what to avoid over time. And yeah, there's so many micro caps that look so good, and then you're
If
in
this,
them
that,
and
and the
it's like you
other,
can't get out of them. So
yes.
so totally appreciate that.
Yeah, I'd say
Uh,
1 to 5 billion is like my happiest place where it's actually a good business that's got some scale, maybe even the best in the world, but they're not gigantic.
And a lot of investors like consider that like almost a micro cap, right? Because
Oh,
we have trillion, cap market cap companies, and a billion I feel like is so small for most institutional investors. But you can buy a real business with real
yeah.
momentum, that can graduate and hopefully become kind of a multi-billion market cap company. Let's pivot to spinoffs, individual names. So, I know there's some names that are on your watch list, including Lennar's upcoming Millrose spinoff, which I'm in the process of doing some work on. But one name that I want to talk to you about is Enhabit, because this name, it's been on my watch list forever. I haven't bought it, but it was a spinoff from Compass over 2 years ago. And the whole thesis, and this is where I really get sucked in, is like the valuation. If you do the math, like, so this thing's trading at 8 times EBITDA, I think. It's a home health and hospice business. The entire home health and hospice industry is in the process of getting consolidated. UNH has bought a ton. They're gonna buy some more. And I think they bought LHC Group. UNH bought LHC Group for 21 times EBITDA. Again, Enhabit is trading at 8 times EBITDA. UNH is in the process. This has been going on for years of buying a Medicis. I think it's the card valuation is about 13 times EBITDA. And so, like, if you just do the math, and obviously, Enhabit has some debt, so that helps. But if this company were to trade in line with kind of where these, at just a 12 times EBITDA multiple, the stock is basically a double from here. I think it's a $15 stock. The issue that I've had is that the fundamentals, it's like there's this great sexy acquisition story, but the fundamentals of the business have just
Sucked.
been trending down. So revenue's been going down, EBITDA's been going down, margins have been compressed over time. And so that has held me on the sideline. I've done a good job of like avoiding just buying on the potential acquisition takeout, but it does look really interesting. I've been intrigued. I revisit like every 3 months. And so I would love to, hear kind of what you think about Enhabit and yeah, how you think about the opportunity there.
Yep. So when I looked at it when it was spinning out. And back then, you look at the historical financials, and this was like business that earned like 40% returns on tangible capital because like you don't have much capital. The person, you got your nurses driving their own cars out to the house of the person. Like there's no hospital where people have to be. You just are hiring people and dispatching them. You've got like a central dispatch point, and you're sending people out. So you earn high returns on tangible capital, and over time this should grow just because of the aging population. Like you're just going to get this ever expanding pool of old people who use healthcare far more than young people. So you've got some good stuff here, like good business with tailwinds. What they and the entire industry has been hit with is you had inflation and you had like COVID, which meant that nurses were hard to get and expensive. So your costs just went up because of general inflation and specifically healthcare, people inflation. So your costs are going up. And then at the same time, you had Medicare cutting the rates that they were paying to home health providers. So they're like, they don't get to control the revenues that they get. Like they make deals with the insurance companies, but Medicare pays best and everybody sort of pays off like a discount compared to that. So if Medicare is cutting what they pay you at the same time that your costs are going up, like that does terrible things to your earnings. And that has happened over the past few years. So it's not just Enhabit, but everybody's getting their faces ripped apart, just like revenues down, costs up, sadness ensues. But fundamentally, it's a good business, and unless Medicare just wants to kill the entire industry, and this is still a cheaper way of serving people, so it's not like a terrible thing to do to allow these things to exist. Then, at some point they have to start raising the rates that they pay these people and approximate the cost that they have, and that seems like it's happening a little bit. Like the last Medicare pricing wasn't as bad for them, and their like revenues will actually go up. So I feel like there are some positive signs that they're not going to be just driven into the ground. But that is the sort of backdrop. Good business with long-term tailwinds has no control over its revenues or minimal control over its revenues, and so this company tried to get away from Medicare, which meant that they went into like more private healthcare, which pays less. So like they self-inflicted lower revenues on themselves, and their costs are the same. Like it's not like a nurse is cheaper if you send them to a Medicare patient or to a United Healthcare patient than to a Medicare patient. It's the same, whatever. So that's the backdrop. I think this is still a fundamentally decent business. I imagine that it gets back up, better margins and stuff like that. But my downside case doesn't have much improvement, but it avoids bankruptcy. So I don't think it goes bankrupt. I think it can get a lot better. I think it started to already get a lot better. Like the company is making moves to improve itself. The nursing cost situation has abated. And I think Medicare pricing is improving. I don't look at, in general, I don't look at M&A multiples in terms of what I think I'm going to get for my investment. Like I care about them to see like, am I way off base with how I'm valuing things? Um, but I haven't seen this as a takeout. I see this as like this is a long tailwind company. If they can just grow the way they used to and earn returns on capital sort of the way they used to, I'm going to make a lot of money. So I've been sitting, waiting, buying as it gets cheaper. And yeah, it's one of the more attractive things I see right now, but the stock isn't moving at all. Um, yeah, but I think it's still cheap. I think it's got some positives that are actually happening.
Yeah,
Yeah,
the other nice thing is like it generates free cash flow, right? Like
yeah,
it actually generates free cash flow. So that's a positive. And then it seems like it seems like the trends are improving. So um
it's
I
not
was looking at
good,
one.
but it's like better than terrible. So
Exactly, exactly. And sometimes you just need something to be better than a little bit better than terrible. And if it's valued, like it is terrible, then the stock can re-rate higher. And if you get some earnings growth, that's great. That's great too. Exactly. The other thing is so yeah, like you've been talking about traditional Medicare versus Medicare. The one thing that's kind of held me on the sidelines, or I'm just watching closely, is traditional Medicare versus Medicare Advantage. So, like, there's an activist presentation that I looked at, and they cited that the traditional Medicare, the gross profit, and I don't know if this is right, but I'm sure it's ballpark right, is $114 per visit, and then the Medicare Advantage, which this is confusing, but Medicare Advantage is basically not Medicare. So it took me a
Mhm.
while to understand this, but it's not Medicare. So Medicare, traditional Medicare, you get a gross profit of 114 bucks, and then Medicare Advantage, which is think of it as not Medicare, you get a profit of $55. And then there's been this big secular shift towards Medicare Advantage.
Yeah.
Patients like Medicare Advantage. So that's a headwind that the company has been dealing with. They have been negotiating. First of all, it looks like hopefully the shift to Medicare Advantage is kind of moderating a little bit, but they have been negotiating better rates for their Medicare Advantage contracts. And so that has been helpful as well. But that mix shift has been a challenge. The positive though, like you said, you should have, it is cheaper to serve, patients in their home. This should be, you have elderly population that's growing. You should have secular tailwinds to this business, which you often don't have with spinoffs. Usually
Mhm.
spinoffs, it's like in a secularly declining industry. And
Mhm.
so it's really nice to have some secular tailwinds for this business. One thing that I don't know if you have any sense, but this is I can only imagine that this is good news. So Enhabit recently announced that they won a lawsuit against VitalCaring's PE sponsors.
Yep.
And I think the ruling is that Enhabit and Encompass will get basically 43% of this business whenever and if it's monetized. Do you have any sense like how much? I don't even know what that's worth, but do you have any sense of what kind of positive that could potentially be?
Um, it's tough to know exactly what that's worth. I'd say first off, it's not bad. Um, Second, it should reduce their legal expenses, which reduces SG&A, which increases profit, which is positive. Um, the like April Anthony founded Enhabit, sold it to Encompass, and she is now running VitalCare and trying to grow it and make it a new Enhabit because she was unable to buy Enhabit um, from Encompass after she sold it, after they bought it from her. So who knows what, like my dream was always that she would come in and take over Enhabit and run it because she's got a great track record. She's good at this stuff. Um, Ideally, this situation, in my mind, gives her a reason to buy Enhabit or for them to merge because this is like the judge created this situation where VitalCare doesn't get to make money off of the people that they stole and the opportunities that they stole from Enhabit by like they bought companies without saying, "Yo, Encompass, you want to pay this company first," and that is a breach of duty. And the judge came down hard on that and said, you breached your duty to your company that you were working for. As a result, I would take away all of your right to make money, but then you just quit working. So I'm going to give you like 40% of the money that you make to Enhabit because I want you to. This is a real slap on the wrist. Like you should be punished for what you're
Really
doing and you should
meaningful.
not
Yeah.
benefit. Um, and so you got this complicated situation. Again, it's not bad news for Enhabit. Again, it's positive for the legal things. I don't know how it's going to work out. I would love to see it work out where they merge in a way that benefits Enhabit shareholders. And maybe April Anthony runs it. Not that the Enhabit CEO is bad. She seems also very good, but she's not. April Anthony is yeah, the one who was made in the Matrix or whatever. She's Neo. So you want her running your show. So I think that this increases the chance that these two companies do something just to unwind this judicial agreement because they put a lot of money into VitalCare. They can't just shut it down and be happy about that. Even if Pride would tell them to be just like, screw this, I'm not working for nothing. But yeah, complicated situation.
I mean, it would make sense. I mean, scale is the opportunity here. Like I was looking, one thing I looked at with Enhabit, I think they have like $25 million of central office G&A per
Hmm.
quarter. And that's just seems like a lot. And it just seems when your margins like aren't that high to begin with, it seems like it's the
Cut that.
reason why UNHs of the world and others and other private equity backed sponsors are trying to consolidate the space.
The I mean, there have been some articles in the Wall Street Journal about why UNH buys these companies, and it is ugly. They're buying it so that they can put these nurses on their software that says, can you diagnose this weird disease for this person? Because we get really good reimbursement rates if you do. Can you diagnose that other disease? Like these weird little diseases that UNH has figured out make them big money with Medicare or with insured, well, I think primarily with Medicare. So they buy these home health things as a feeder for these high cost or high Medicare payment treatments. So private equity buying them would be for scale. UNH buying them would be to get this money, to use it as a feeder for diagnoses that are beneficial for UNH, which is why people hate United Healthcare.
Hey, United Healthcare, yeah.
Because they do
Um,
stuff like this. Yeah.
yeah, that's I think I read that article in the journal, and it was like an independent investigation saw that like these diagnoses that United Healthcare is diagnosing at very high frequency
Way higher
rates.
than normal
Yeah,
other
way
people.
higher, like 100 times more frequent than all the other guys. So yeah, it seems a little sketchy.
Yeah. So I saw that and it somewhat diminished my hopes for like a big M&A payout because like now that that's in the journal, things tend to happen.
Right.
Yeah.
And then the other thing is insiders have been buying like crazy. So they've been buying, you look at the insider buying, I mean, ever since really the spinoff, right? They've been buying consistently. So that has, yeah, exactly, averaging
It
down.
doesn't,
But
not a great
sometimes,
track
sometimes
record.
that works out. Like I think with Zimvi, like I think insiders were buying, that was a spin-off, and then eventually like the value got unlocked and that one, more than doubled. And so yeah, sometimes insiders are early, but I think that is not again, that's not bad, right?
Yeah, it's not bad news to see this. Like I'm happy they're in there. I think I paid cheaper prices than than those guys. But I'm glad they're buying instead of selling. If they sold, it would be really bad. Yeah.
Okay, so let's talk about a couple other spinoffs that are on your mind. We don't have to spend as much time on them, but
No, no.
I know we talked a little bit about Millrose, and that's going to be the Lennar spinoff that's coming up. I know Vivendi has done a couple spinoffs, which I'm still kind of working through the math. They
Me
all
too.
kind of look cheap to me,
Yep.
but we're curious, today, like what's on your mind? Where do you think there's potentially interesting opportunities?
Well, just Millrose first because it pisses me off. Like Lennar is spinning off this land bank, which sounds really cool. They did it like it seems to me like a land bank would be an interesting business to have. Like there are no other publicly traded ones, but they put so many restrictions on it that it's just like this little bonsai tree that they've put out into the world that can't grow. Like the money it makes from Lennar is between 7 and 10%. So it starts out at 8.5%. They're going to get this option premium for the land that they buy from Lennar. Lennar then develops it for them, and they get 7 to 10% based on triple B interest rates on the total value of the final land that gets sold back to Lennar. They don't make a profit on the land; they just make this 7 to 10%. So right now they're making 8.5% on the total value of the land that Lennar will buy back to build houses. And then they're paying, I think, a 1.25% management fee. So now you're down to 7.25% return on capital. With that, you can't borrow money from debt and do anything to improve your return on equity. It's just like a crappy return on assets, or crappy return on capital. And so I see this little business that it's earning 7% or something like that. It should not trade at book value if it's only earning 7%. It should trade below book value, which means they can't sell stock to grow. They can only take on $1 billion of debt to try to serve another customer. And so if they don't get a good customer from day one who pays them, I don't know, 15, 20% return on capital, they will never grow. And they will be this stuck as a tiny little company forever. So they got one shot. And it's just like, Lennar, you had this opportunity to make something beautiful, but instead you just have this little stillborn baby that you put out into the world that will serve you. But like as a shareholder, I'm disappointed because I was hoping it would be something better, or as a potential shareholder,
What were you hoping for? Like what would be a better scenario?
where they're not stuck between 7 to 10% return on capital. Like inflation, if inflation goes up, like, and you're still maxed out at 10% return on capital, like you're just shrinking. Like your best case is that like rates are 0 and you can earn 7, which is still not that great. I wanted it to be a real business that could earn like 15, 20%. Like private equity people do this. They're not doing it for 7% return on equity. Like if you made it a real business that was publicly traded, it could grow, it could do cool stuff. But they locked it down so hard to only benefit Lennar and the Miller family. I see it as a preferred stock. So it's a preferred stock that's going to pay you something like 7%. And if you can get that at a cheap enough price, great. But pays a $2 dividend maybe. If I can get it for less than 20, maybe I'm interested. But it's really like you created a preferred stock. Congratulations. Yeah, sorry, I'm a little bit butthurt about it because I wanted it to be something special, and it's not. It's not something special for shareholders.
No, that makes complete sense. Does it make you more interested in Lennar, the fact that they're taking these land assets, 5 or 6 billion of land assets off their balance sheet, making it less capital intensive, obviously trying to
The
shift their approach?
Yeah, they want to be NVR, and they want to get NVR multiples. So it makes me interested looking at NVR to be like, wait, is this what's really happening? Like, I don't know. I've never looked at NVR. I I think maybe I'm too butthurt about it to be objective. I think this is a positive for Lennar. I look at it as like you screwed your own shareholders and you created this ugly thing. Like you're trying to be a little bit too clever. Like it's clever, self-interested, but like it would be more beneficial for them and everybody if they made something better. So I'm like, you're smart, but you're not as smart as you think you are, and I'm pissed off. So no, I'm not. I should be looking at Lennar. That's the one to look at, but no, I'm not because I'm yeah
Yeah, it's
emotional.
the I guess the other thing is that I was kind of so basically Lennar's paying an option value, and I think the
Mm,
option fees come out to, I think, if you do the math, I think on an annualized basis, I think it's like between 350 and $400 million they're going to pay Millrose Properties, per year. But I guess I got to look at this a little bit more closely, but I also think that if what if Lennar kind of walks away from the arrangement? Like they decide they don't want to pay these option fees, and then for some reason we have a GFC type situation, and Millrose is just stuck with these properties, and they don't have any option income coming in. I guess it seems like this situation is so favorable for Lennar that it seems like an unlikely situation. But do you have any thoughts on that? It seems like kind of like a one-sided relationship where it's
Oh yeah.
it's the risk is kind of asymmetric to the downside.
Yeah, I think most of the time you're getting this like 7.25% return on capital, but there's a chance of complete annihilation. So I think that is not like Lennar has created a situation for themselves that is so beneficial. They will want to keep this running um, as much as they possibly can, and they've got a policy of just always producing. Like they want to run their home building like a factory, so it's just always running, even if prices go down. So they have an operating model that says keep using this all the time. And they've got financial incentive. Like they put, I don't know, $5-6 billion into this thing, and just to have that go poof, that would be pretty crappy for them because then they would still have to go out and buy land
And
for the
by land, they
next.
still need land, right?
Yeah, they're always going to need land to run this home building factory, or just to run a business, even if it's not a factory. So there's a chance that it goes like totally bad, and Lennar does not exercise the options, but that would be Lennar does not want that to happen. That would just be like things are really, really bad for them. It would force them to do that option. Um, but it's there. So it's like upside of 7% return on capital, downside minus 100. You made something beautiful.
All right, so we're not excited about Millrose. What about any other spin-offs on your mind? Have you looked at any of the Vivendi companies that were spun out?
Yeah, I would say like as pissed off as I am about Millrose, I don't think this gets a fair price. Like they
Hmm.
built it to get an ugly price. It's taxable spinoff. It's a taxable hold like operating co in the REIT. So it's like your REIT disadvantages with taxes. Like they made it ugly to benefit themselves to have a low tax distribution. But if it gets cheap enough, like there, there is something there, like below 20, like maybe it is interesting. Um, I've looked at Havas. I have glanced at Canal Plus. I don't know how we're supposed to say it, and not be pretentious. Um, but that one got too complicated for me. There's a third one listed in France that sells books. I haven't looked at them yet. Maybe they're the best, but I haven't even looked at them. Um, and that one has debt, so maybe. But Havas, I looked at. It's an advertising company. They make ads. They help people buy ads, and then they've got a big, they call it a healthcare business, which I think is pharma ads, which people might be scared of here, because that's U.S. is probably the bulk of where that happens. I look at it and it's a good business, like good returns on tangible capital because tangible capital is negative and they earn money. So it's like the operations produce a lot of free cash flow. Um, I look at it, what happened to Havas in the financial crisis, and it was just like margins went up, revenues went down for a year, and then they came right back in 2010. So it's like this is a far more stable business than I would have thought. Like they got hurt in COVID too, but like again, it just like comes back pretty quick. So people say that this is like way tinier than the big guys, than Omnicom or whoever. But I'm like, financials still look good to me. They spend a lot of money buying up other little ad agencies, and that's not cheap. So their returns on invested capital are more like 10, 11%, which is not great. But I valued it. I did my upside downside valuation, and it was like, okay, upside, it's worth like 460 or something like that. Downside, it's worth, I don't know, 2, 3 or something like that. And look at the stock, and it's like 160. I'm just
Hmm.
like, okay, where did I make a mistake here? Like maybe I have made a mistake. This is like recent. Um, but I look at this and I'm like, this is not the world's greatest business, but it grows over time. It's got decent returns on invested capital, like whatever, you're earning 10%, 12%. And it grows a little. You're paying out a dividend that I have to pay withholding taxes on, which I don't love, but like the price is right. Um, so it's not the world's greatest thing, but I think it's super cheap and for a good business. Um,
And then advertising agency. So basically, like a client will hire an advertising agency to help them basically run their advertising campaign. Is that I don't know much about advertising, the advertising business. Is that pretty much it? Why a company would hire like an Omnicom or a Havas?
I think so. It's like communication strategy broadly. I don't know if
Yep.
that includes like political stuff as well, but it's like communication strategy broadly, how you're buying your ads, like
Hmm.
what Facebook, Google, Instagram, all
Yep.
that stuff. Um, how you're buying it. I think they've also got the division that like makes the ads. So it's like the strategy of it, but also the making of it. And then this healthcare piece of like, let's sell more drugs to people. yeah, like I'm still learning about the business, but I look at the numbers and they're good. Maybe it's going to completely be destroyed by AI somehow. But I don't think the other big players are showing me that that's what's happening. It just looks like a very cheap stock.
Yeah, me, I need to spend more time on that. I've been spending more time on Canal Plus.
Hmm.
Um, it's just like it's taking me time to kind of wrap my hands around it. I'm like, how does the French TV market work? Like, is this business exposed to linear TV? Is it not exposed? So it's just taking me a while to wrap my hands around Canal a little bit. But Havas seems like it's a more understandable business.
That's why I did it. I was like, all right, like Canal Plus, it's like, okay, you got Paddington. I've read that like 5 times now. And then like there's a South African thing that's coming in, and then
Right,
it's
that
media. And
merger,
I'm just
imminent
like,
merger. Yep,
yeah, I'm just like, all right, well, let's go with a simple one here. That seems
yep.
like I'll try that, and maybe the book one. I'll check that too. I think I should check that because I've seen people write about Canal and I've seen people write about Havas on Twitter, but I haven't even checked for the other one.
There's a
Um,
good podcast episode on Andrew
yeah,
Walker's Yet Another Value podcast about
okay,
that, and it was
yep,
done pre spinoff. But that's a good one to get you up to speed.
yeah. I feel like I'm a month late on this, which I don't like to be because
Yep.
I thought, oh, it's Vivendi, everybody and their mother is going to be looking at it, and it's like, well, actually, the special situations community has dwindled to a thing, so even if everybody's looking at it, it doesn't matter. But Canal and Havas have both have insider buying, and I think that put it back on um, my watch list. But I would have preferred to have been doing this work last month. Um, Life happened. Yeah.
Yeah, right. With me, my primary focus is like US special situations, and then the US the ex-US situations are really interesting. Like Jackson was a UK company that spun off a US company, so that
Yes.
was that was pretty interesting. Thungela Resources was like a coal company that was like, was pretty interesting. And so I love the international setups because I think there's even fewer people looking at them. But yeah, my primary focus is on the US, and then if something's kind of like slamming me over the head that it looks attractive, then I'll kind of dive into it from an international perspective.
Yeah, there's like the Greek concrete company that's coming out. I don't know if that's an
Yep.
IPO or a
Yep. I
spinoff.
think it's an
I haven't looked
IPO,
at
but yeah.
Yeah, I haven't looked at it because I'm like I don't know if concrete companies are that good. I know they have local economies of scale and Monarch Cement a few years ago did some stuff and yeah, I missed it, whatever. Um, I have trouble getting excited about concrete companies. I don't know. I would do the aggregates or whatever, the pits. Um, The gravel pits, I like those,
Yep.
but I didn't
Right.
buy Knife River, and that's another one where it's like this is a good business that will last. Why don't I just own a little bit? Not cheap. Yep.
Totally. Um, cool. Well, Christian, that's really all I wanted to cover. This was incredible. I'm looking forward to seeing you at Berkshire in
Yeah.
May. And anything else that you want to kind of cover before we wrap up here?
No. I've been impressed with the French spin-offs, like Pluxee. I liked from Sodexo. Um, and I like this Vivendi stuff. Like I'm sort of surprised that France has these interesting spin-off things happening right now. It
Yeah, what
doesn't
about
fit the
Pluxee?
narrative.
So like what so because that one looks super interesting and looks cheap, looks like a pretty
Uh,
good business, looks like it's actually been growing. And
yep.
I'm like, what am I missing with this one? So yeah, what are your thoughts on Pluxee?
I bought a little. I haven't
Yep.
added to it. Like maybe I'm too conservative. I was hoping to get it at a really cheap price, but it came down. I wanted it at like 14.50 and it never quite got there, which
Yep.
because I was trying too hard. But I see that like I wanted that at a big discount to my downside value, but like this is a good business that's like I think doing well. Like it's a flower. Like operations are coming in better than I would have expected.
Seems
I think
like
a
it.
big part of it is like they benefit from higher interest rates. So like there was a story last year that Edenred and Pluxee were like so cheap because interest rates were declining, especially in Europe, and that really does matter to these guys. They make money several ways on interest rates, and they also make money on doing the actual vouchers. Um, but the big money seems to be interest rates. But like Pluxee is like a big Brazil business, and it's like in emerging markets. It's not so much in France or in like euro interest rate places. It's in places with generally higher interest rates. So I thought that that was like their interest rate income is going to continue to come even if the EU lowers their rates. And now it seems less likely that rates will be lower. Like it's not the guaranteed situation that people thought it was a few months ago, which is only good for Pluxee. Yeah, I think it's a good business that benefits from higher rates. Stuff's rolling for them. It's good.
Yeah,
It's not as
one
cheap
one
as it
thing
was, but it's good.
one thing that's a little different is I guess they're basically a company benefit manager, right? So as I understand it, if you're like a company in France or maybe Brazil, a big part of your kind of compensation package for employees is like meal vouchers and other type of vouchers and perks that you give to your employees. And so this company in Edenred manages those businesses. And so, like to your point, as I understand it, they get paid by the company, and it's basically kind of like float. Like they can earn cash on
Yeah.
that money while it waits in the bank account, and they before they have to pay out the benefits. And I think one thing it's just not really an Anglo-Saxon concept. Like that doesn't exist in the US, or I don't think in the UK. So it's just something that's like I was very unfamiliar with, but apparently it is a pretty durable business. It's been around for many many years in France and other countries.
I think it's a situation where if you have a country with high taxes on companies, high taxes on employee income, then these are sort of like paying for people's food and paying for people's other stuff is a way to give them tax-free benefits.
I
So it's like
see.
I could pay you $100, you get to keep 50, and then you can go out and buy lunch. Or I can pay you $90 and give you a $10 meal voucher. And so now you have 45 plus 10, so you have 55 like take home value. So I'm going to do that. And so like if you have countries with high taxes and maybe onerous regulations, this is a way that big companies can like figure out a way to navigate the system. Small companies have trouble doing that. And like Pluxee is the person who helps you navigate this thicket of regulations. So if the world gets wonderful and regulations go away and taxes go down, like it's bad for Pluxee. And if interest rates go down, it's bad for Pluxee. So you're sort of betting on Brazil continuing to be Brazil and like other countries continuing to be the way that they are.
And France continued to be France, which is probably a good bet.
Yeah, France isn't as big of a deal for Pluxee. I think Edenred owns
Mhm.
it. But it's countries that in my mind are like that. Great to visit, not necessarily where you want to start a little business.
That makes sense.
Yeah, that's my view. I might be complete wildly off
No,
on
that's
that
really
with my
interesting. And if any people that are
US
watching this or
goggles.
listening to this have any feedback, definitely let us know. All right, well, Christian, this was super fun. Would love to have you on another time when there's other interesting spin-offs. But
Yeah.
what if people want to learn more about your fund that you manage or just want to connect with you, how can they get in touch?
I'm on Twitter. I think I accept DMs. I just don't write to people, so I don't get very many. But yeah, you can find me on Twitter at Curreen CR, CURRENCR. Or you can just come and like sign up for my mailing list, then you'll read about what we actually buy. Lately, it's been like little nibbles, but they haven't been terrible, so you can buy them. Um, yeah, so come to the website, Curreen Capital, sign up for the mailing list, or just hit me on Twitter.
Amazing. All right, Christian. Well, really nice catching up. Look forward to, like I said, catching up in Berkshire and take care. Really appreciate you taking some time.
Thanks. Had a great time. Bye, Rich.